Welcome, everybody. I think we are just a couple minutes past 4, so why don't we get started? I'm Jennifer Pline, the head of wealth management at Cambridge Trust, and appreciate that you are joining us today. I hope that you are staying warm, inside, healthy, and also coping well with the ongoing pandemic. It feels like we're starting to see a little bit of a light at the end of the tunnel, but we will still be in this world for a little while longer. I'm going to introduce the panelists first, and then each of them will speak briefly, and then we will answer questions. I do want to remind you that this is being recorded, and if you do have questions, you can put them in the Q&A box, which should be at the bottom of your screen. I'm also seeing people joining us, some of whom I haven't seen in quite a while. So welcome to those of you who I know well. And let me just start with introductions. So Susan Martori Baker she's at the center of my screen in any case, president of Cambridge Trust, New Hampshire. Dave Lynch, our chief investment officer, is here as well. Brian Bickford, senior portfolio manager. Stieg Zarl, portfolio manager, and David Strawn, our head of relationship management. So as I said, each person is going to spend a few minutes mapping out an introduction or an update on Cambridge Trust. We're going to talk about the investment markets, and then Stieg will talk a little bit about the healthcare sector, which is his area of specialty, and he'll be talking about how those companies are doing in terms of creating COVID vaccinations. And then David Strawn will close us out with some information on tax changes and comments on the Secure Act. So again, a reminder, if you do have questions, put them in the Q&A. And I will turn it over to Susan Martori Baker to begin. Susan.
Thank you, Jennifer. And thanks everyone for joining us this afternoon to hear from some of our senior portfolio managers and administrative professionals. We have the honor here at Cambridge Trust of managing over $4 billion in client assets, and we value each and every relationship. At Cambridge Trust, we provide comprehensive wealth management, and we're often asked, well, what does that mean? For us, it means looking outside of each of our roles to be sure that a client's full and complete financial life is successful. So many of you already know of our wealth management capabilities. You know that we manage your portfolios. We provide administrative services, either to you or to your organization or your family. I'd like to highlight some of the other ways Cambridge Trust can help with any financial needs that you might have, either now or at some point in the future. Cambridge Trust is a bank, so as you'd expect, we do offer checking and savings accounts at any of our 21 office locations in Massachusetts and New Hampshire or online. But did you know that right now we have a high-yielding money market account for new deposits? We can also be helpful if you're looking to escape the city and buy that vacation home on the Cape or in the mountains of New Hampshire. And we'll make the mortgage loan process as easy for you as possible with an experienced mortgage lender to guide you through the process. Our rates are pretty competitive, and we have a number of options, everything from a 7/1 adjustable rate to 15 and 30-year fixed. We can also have interest-only payments if that's preferable. The point is that we're here to consult on the right loan for your specific situation. Our commercial lenders are also ready to help with your commercial real estate and other commercial loans. They have a tremendous amount of experience helping businesses grow with specific expertise in innovation lending, technology, life science, and solar energy. We're also a bank that cares deeply about our communities, and we strive to develop strong client relationships and community partnerships. So if you're associated with a nonprofit, you might be interested to know that we have a special suite of banking products that might benefit either your organization or the people who count on your organization for assistance. We're also a bank that cares deeply about the communities. We strive to really develop strong community relations. And Cambridge Trust has a commitment as a company to diversity, to inclusion, and here are some of the details of that commitment. Last year, we increased charitable giving because of the pandemic by more than $500,000. We approved and closed over 1,000 PPP loans, which saved more than 20,000 jobs. We allocated 100,000 towards eradicating racism while supporting organizations working toward racial equity within the communities we serve and where our colleagues live. Our employee volunteer program provides hundreds of hours of support to many local nonprofits in Greater Boston and Southern New Hampshire. And our employees coach and counsel first-time home buyers. We teach financial wellness in local schools and at nonprofit organizations. That's through our Cambridge Trust Cares program. We also teach English as a second language classes to local immigrants. And our employees together provide guidance and leadership to many local nonprofit boards and advisory committees throughout our footprint. And did you know that Cambridge Trust was recently recognized by the NASDAQ as the #1 company having the most women on the board of a NASDAQ listed company? We're pretty proud of that. As well, we were recognized as a top 15 Greater Boston company with the most diverse corporate board. We love being your bank for all your financial needs. Our approach is truly comprehensive. So if there's anything that we can do for you, I hope you'll let us know, either by contacting your relationship manager if you are a wealth management client, or by contacting us for banking needs online or at your nearest office. That's an update on Cambridge Trust and all that's going on here at the bank. Now I'd like to turn the microphone over to David Lynch, our Chief Investment Officer, who with some of his colleagues will provide information about the state of global investment markets.
Hi, good afternoon, everybody. I'll provide some of the overall viewpoint that myself and the asset allocation team are putting forward right now. And then Brian Bickford will follow up with putting some more specifics and a finer point on some of the themes that I'm going to talk about. The general state of the investment world right now is earnings are good. Stimulus is still abundant and perhaps even more coming. The election uncertainty is largely behind us, or certainly shrinking. There are still some transitions going on, but at least the winner and so forth is known, and that is soothing to the markets almost regardless of winner. Getting beyond an election is typically a good thing in terms of knowing the upcoming playing field to a greater degree. A lot of the cash that was on the sidelines, some of it is still there, a large chunk of it is still there, but it's starting to cautiously come back into the market as well. And there's general COVID optimism in that the market is a very forward-looking anticipatory tool and barometer. And so though the headlines of any given moment about COVID are not great, and certainly some of the challenges in the vaccine rollout and some of those things that Steve will be talking about later are unfortunate in the current moment, the market to an extent is already looking out beyond that towards what will hopefully be a better summer and autumn, and certainly beyond that for the U.S. specifically, and of course the world generally. And so that is starting to be taken into consideration. Though there is a bit of an awkward irony here that that it's part of our job to consider the market implications, even though we are rooting very hard for COVID to go away and the economy to come roaring back and our lives, friends and family to come back to normal. We in the markets are watchful for possible transition where good news starts to become bad news, in that much of last year in investment terms, bad news was a good thing for markets because it meant more stimulus would be needed, and the political hand was being forced just by how dire the situation was. And also it meant that interest rates would be held lower for longer, sort of as far as the eye could see. Certainly when the fog of COVID was at its worst. But as some of those things start to resolve themselves, again, to the good of the world, it could be in the forward-looking market sense, the market could start looking forward to things where, are things going too well? Meaning, with all of this abundant stimulus out there, as well as the economy starting to recover and perhaps roar in terms of a global synchronized recovery in its own right, could we tip towards inflation in a bit of an almost unruly recovery? And why that would be a problem, it's a good thing in a lot of ways, is that it could mean that interest rates would have to start pricing in inflation, or maybe the Federal Reserve being not quite as friendly, at least not for quite as long as sort of currently anticipated. So those would all be good things if some of the stimulus and rates could be removed. But in a financial pricing of assets sense, it could pose some challenges to the market. So that's where our internal debate focuses on, a lot of that inflation and interest rate discussion. So next, to talk about some of the things that we're doing in portfolios to consider current market valuations, potential angles around inflation and interest rates. And just a quick sidebar is I'm going to present general recommendations and advice. They may not apply specifically to every last one of the listeners on this call and videos portfolio. That's something that we pride ourselves on, being pretty highly customized in concert with your individual relationship manager and portfolio manager. But I think directionally, this should apply to most of you on the call, and we're happy to follow up with greater detail thereafter. We are neutral to equities. We are underweight bonds, and we are slightly overweight cash. And so one of the things that we're considering and working hard on as a research team is adding some more commodities and real asset exposure, hard asset exposure, if you will, to portfolios. So what has been great for financial assets, and in that regard, I mean the stock market and the bond market, both kind of collectively considered financial assets. If the conditions for financial assets, or at least the desire to diversify maybe away from them to a degree, might move towards things like hard assets in commodities, we think that could have good diversifying properties for client portfolios. So stay tuned for that. We're working hard on what instruments to best implement that for clients. We're not going to get in the business of taking deliveries of a barrel of oil or a bushel of wheat, but there are instruments out there via ETFs or mutual fund type formats where we think that it could be a great addition to client portfolios, not only for the short term, but really for the long-term kind of demographic changes of the world and in commodity cycles as we go forward. And so that's one of the newer themes that we spend a lot of time on. Before I cede the floor, a couple of other themes that we're working on. We continue to be scrutinizing the international market and adding back some of the international exposure that we've been largely underweight, which has been a successful underweight, but starting on a relative value basis to add back some of that international diversification for most clients. And also rotating winners, not departing to zero. Some of our highly successful winners that carried client portfolios through the turmoil with great success, particularly some of the technology and growth names. But to be clear, we do need to make some room, if you will, for some of the underperformers and some of the recovery names, the beaten up names that could be positioned to come back. So it could be some trimming and rebalancing going on to effectuate that rotation. Same for bond portfolios, doing some rotation there. One current example is for those clients that own mortgage-backed securities, rotating them towards more corporate exposure. Lastly, a couple of quick things in our equity income strategy. We're working to add a little bit more yield to that strategy. Yield is pretty scarce in the market, but nonetheless, we're working to add some more yield to client portfolios there. And within our sustainable and responsible investment strategy, we're working to add a little bit more impact to the portfolio, a little more positive attributes and renewable energy among them as that portfolio pushes for greater kind of impact and active role in portfolio and deployment of money. So lastly, before I hand it off to Brian, we hope that some of our publishing is helpful, and invite you to get on our mailing list if you're not already, and relationship managers can help with that. So with that, I wanted to, and I will be part of Q&A later, of course, but with that, I wanted to pass it over to my colleague, Brian Bickford. And Brian's going to talk to us a little bit about how the stock market has had such a tremendous run, what has driven it, and how we're considering, further fine points on that positioning that I talked about just now. So Brian, over to you. Thank you.
Thanks, Dave, and welcome everyone. Yeah, so as Dave indicated, I just wanted to reflect back on 2020 a little bit. And, one of the most common questions from clients that I received, certainly from mid-20 on, was how is it that the pandemic, in the midst of a pandemic, is the equity market performing so well? And coincidentally, last week, we hit the 1-year anniversary of the pre-pandemic peaks in the S&P 500 on February 19th of 2020. And as the gravity of the pandemic hit the market, the S&P 500 declined about 34% from February 19th through March 23rd. The Federal Reserve responded very quickly with 2 unscheduled FOMC meetings, Federal Open Market Committee, and through those actions brought the Fed funds rate down to 0. In addition, the Fed balance sheet went from $4 trillion to now $7+ trillion, meaning that the Federal Reserve, through its ability to electronically print funds, went out into the market and purchased fixed income securities in order to add liquidity to the market and keep not only short-term rates down, but also long-term rates. And then, of course, then President Trump signed the $2 trillion fiscal stimulus package, the CARES Act. And throughout all these stimulus, both monetary and fiscal, the money supply increased about 25% year over year. So in other words, money market account balances, checking account balances, cash deposits, et cetera, increased roughly 25% through all these actions, increasing, liquidity and the ability to have, flush, checking accounts, et cetera. It did not take that long through these actions for the S&P 500 to recover. By mid-August, all these actions contributed to the market rebounding up and overcoming the 34% decline. So another historic example of why sticking to a strategic asset allocation, made sense and worked out, and staying consistent and disciplined in your allocation once again, proved to be the way to work through a very difficult time. Since then, we've seen markets continue to move higher. So after August, we saw in the third, fourth quarters, equity markets continued to improve and provide positive returns. However, increasingly, it was earnings improvements that provided this. It wasn't simply the central bank activity as well as the fiscal stimulus. We saw actual corporate earnings start to move higher. We're just now edging towards completing the fourth quarter of 2020 reports, with 80+% of the companies reporting, and 2/3 of the companies that have reported have beat their estimates by over a standard deviation. So a material outperformance compared to expectations. And when we look at the fourth quarter of 2020, we're expecting the earnings for that quarter to be about 2 to 3% higher than the fourth quarter of 2019, pre-pandemic. So we're getting to the point now where earnings per quarter are starting to get higher than the pre-pandemic levels. Also, somewhere around 70% of the companies in the S&P 500 have reported or have seen their earnings revised higher by analysts. And we're seeing a similar phenomena in developed international markets as well as emerging markets. And for calendar year 2021, we're expecting earnings to come in somewhere around 7% above calendar year 2019, pre-pandemic. So again, through good management, through the actions of the central government and central bank and governments, helping corporations, generate earnings, managements making adjustments, et cetera, we're seeing earnings truly move higher. So that brings us to where we are now. So far in 2021, we've seen the S&P 500 continue to move higher. We're up about 3.5%, 4% year to date. And so, some of the concerns, risks, and opportunities, as Dave alluded to, are, higher rates and increased inflation, partially due to some of the stimulus that we've seen. We've seen the 10-year Treasury yield move up about 0.5% over the last 3 months to 1.35%. Still low from historical perspective, but we're still seeing, in general, the rate, move higher. We're also seeing, commodities prices move higher. The reason why, as Dave indicated, we're considering adding some hard assets to portfolios. Industrial metals, including copper, have been up about 25% in the past 3 months, and oil has been up close to 35% in the past 3 months. So, some risks out there that are concerning us. And as Dave indicated, throughout the good portion of 2020, the question was, why is the market doing well with all this bad news? As we head into 2021, we're looking for, concerns and things that, good positive news may be met with markets that you'd expect would react more positively. And it's exactly as Dave indicated that, we're waiting to see if the, central bank might begin to pull back on its accommodative policies. As far as catalysts for future growth, there's plenty of those as well. Cash is still flush. We've seen cash come down a little bit, but corporate balance sheets as well as consumer balance sheets, are still very flush with cash. Savings rates, we're at very high savings rates historically, somewhere around 13% right now for consumers. As I mentioned, earnings improvements, and we're waiting to see, if Congress is going to move ahead with the American Rescue Plan Act of 2021, an additional 1.9 trillion of stimulus, and what the impacts might be of that, to markets as well as Fed action. So, more to take a look at and keep watching closely. And then, of course, the virus numbers are improving as was indicated. There are variants out there, in addition to the rollout being, less than optimal, but clearly, the numbers appear to be improving. So with that, I'll hand it off to Steve Zarl, our healthcare analyst.
Great, thanks, Brian. Yeah, I'm going to take a few minutes to give you guys an update on COVID, the virus, the vaccines, really from a healthcare analyst standpoint. That's, as Jennifer alluded to, that's one of the industries that I cover as an analyst as well here at Cambridge Trust. So first, thought it would be helpful to put everything in kind of context relative to the speed of the global healthcare industry's response to the pandemic, which has really been outstanding. The industry has been able to develop multiple vaccines in under a year. And this is really abnormal. It usually takes about 5 to 10 years to develop a vaccine under normal circumstances. For example, in the past, 2 of the quicker to market vaccines were one, the mumps vaccine in 1967. It took 4 years essentially to develop that. And the Ebola vaccine more recently, that took about 5 years to develop, and that came to market in 2019. So we're talking about less than 12 months to develop multiple vaccines for COVID. It's remarkable. And then another thing that was kind of stacked the odds against the industry going into this is historically only about 40% of vaccine candidates are approved for use in humans. So again, another really tremendous response by the global healthcare industry. Currently, I've mentioned 2 or 3 vaccines. There's still over 100 vaccines in various stages of trial at the moment, and 20 of those are actually in advanced human stage trials. So it really looks like we're going to have more new news flow as it relates to vaccines, hopefully most of that good, in the coming months ahead. And it hasn't been all about vaccines. The industry has done a tremendous job with treatments, and that's in the form of antivirals, antibody cocktails, monoclonal antibodies. All of those really help treat severely ill patients and greatly reduce the risk of the risk of death, essentially. So more good news coming on that front as well. So the other thing, as Brian alluded to, is, obviously there's been a lot of talk about mutations and variants. The South African variant, the UK strain, the Brazilian version. It really is important to note that mutations, the idea of mutations among viruses is fairly normal. The influenza virus mutates on a regular basis. To be more specific, the South African variant does appear to be a bigger challenge than the other variants thus far, but some of the current vaccines actually do exhibit effectiveness, albeit at a reduced level. For example, Johnson & Johnson noted in recent data that their vaccine candidate, which is not yet approved in the US, was 72% effective in the US, but 57% effective in South Africa, in a trial in South Africa. So still, decent efficacy on that front. But I think when it comes down to mutations and variants, the really key thing to understand is the drug companies can pivot pretty quickly when it comes to vaccines. For example, Moderna, in developing their vaccine, it took them just 6 weeks, 42 days to get the code, kind of the genetic profile, to the production of a prototype of a vaccine which they pushed along to the FDA for some preclinical testing and what have you. They're pretty confident that they can do that again, and maybe even more efficiently, with new variants as they come along. So I think the bottom line on mutations and variants is, yes, caution is warranted, but the industry really can adapt to changes pretty rapidly. The other area of controversy has been distribution and dosing of the vaccines. Certainly been fits and starts from the beginning, but we actually are seeing pretty marked improvements over the last few weeks. The rate of dosing is accelerating. We're up to about 1.6 million doses per day here in the US. That means about 20% of the overall population has received at least one dose. And you think about that 20% that's received that, it has some form of protection, combined with people who have had the virus before. They have some natural protection, some form of antibodies, in their system. So that that works out to be about 9% of the population, based on reported cases, which is quite low. We are slowly seeing increased levels of protection in the US, and that's only going to build over time. So some positive news on that front. A couple of key dates worth pointing out is this coming Friday, the FDA will consider J&J's application for their single dose vaccine. Assuming that's approved, we should start to see the J&J vaccine in the market in a couple weeks after that approval date. Another notable upcoming event is Novovax, which is a small Maryland-based vaccine developer. They are expected to report phase 3 trial, so final trial data, sometime in March. They have said publicly that they can get about 100 million doses into the market by the end of the summer. So yet another source of incremental supply. And then to top it all off, the companies Moderna and Pfizer, Moderna especially, is getting more efficient with their supply manufacturing. And they've actually moved up the timeline on delivering 200 million doses by a couple months. So what that all boils down to is we actually in the US could be in an oversupply condition of the vaccines, in mid to late summer to early fall, assuming there are no hiccups. So things are progressing positively. From an investment standpoint, I'll close it out on this. In client portfolios, we have had exposure to many of these themes. We've had it via vaccines, through drug makers like J&J, and life science tools manufacturers like Danaher, via test providers. Becton Dickinson is a big one there. And then via medical consumables like syringes and glass vials and syringe components, again, through Becton Dickinson and a company called West Pharmaceutical. So we've had exposure to this theme for sure. So, end of the day, to summarize it, things are definitely trending in a positive direction. And I think we as an investment team are pretty encouraged about the progress and the pace of the COVID response, pretty much globally. So with that, I will hand it over to David Strawn, our head of relationship management.
Steve, appreciate it. I'm here to talk today a little bit about some tax and legal changes that we should be aware of. And many of our clients should be aware that the Secure Act was passed into law in December of 2019. Now, Dave mentioned the CARES Act. This is separate from the CARES Act in that the Secure Act was passed in late 2019. And there's a couple of things that our clients should be aware of. First of all, there are two very beneficial items. First of all, the related to retirement accounts, the required minimum beginning date for taking withdrawals from an IRA has been increased from age 70 and a half to age 72. So this can really lead to some potential extra retirement savings. In addition, donors may continue to contribute to an IRA past age 70 and a half as long as they have earned income. So if you continue to earn income well into your 80s and 90s, you can still contribute to an IRA. But of course, where Congress gives, they also take away. So there's also a major change for donors of their IRAs to consider when they want to pass on assets to their heirs. The beneficiary or beneficiaries of a retirement account after the death of the survivor of the donor and their spouse must fully withdraw the value of their account within by the end of the 10th year after the date of death of the survivor. This creates immediate income, and that has to be realized and taxed instead of in the prior regime where we were able to defer the IRAs over the lives of those subsequent beneficiaries. So this creates a lot of planning things that people have to think about. When should you start to take your required minimum distributions? Should you take early withdrawals to try to pull down some of the value early? Is a Roth conversion an appropriate option? Should your retirement funds be invested differently from your after-tax assets? Who or what are appropriate beneficiary designations? And should you designate a charity or charitable trust as an ultimate beneficiary of your IRA? So these are all items we're happy to chat with our clients about and to go over scenarios with our clients to talk about what could be the best situation for you. I also wanted to speak just very quickly on as Dave mentioned, with the certainty on the election now. We know that President Biden is in place and he will be putting forth some tax packages, but we don't know what is it going to be in the tax packages. We know that the Biden administration has endorsed many of the tax plans from the Obama administration and the Bernie Sanders campaign. So there may be some reversions from the Trump era tax laws. The timing and inaction of these will depend on congressional agendas. Legislation could be retroactive to January 1st of 2021, or it could be effective by 1/1/2022. So really keep your eyes open there, and we will certainly keep you informed as time goes on. But regardless of the legislation, there are still some tax changes that are already scheduled to happen regardless of legislation. The federal gift and generation skipping tax exemptions are scheduled to sunset back to $5 million per person on January 1st of 2026. So that we know is going to happen. The income tax rates are also scheduled to revert back to their old brackets, topping out at 39.6 on January 1, 2026 as well. So it is important for our clients to consult with their advisors to plan how these changes will affect them. So I'll pass it back to Jennifer, but Jennifer, there certainly is a lot for our clients to consider as we go through the next few months and years, and our relationship managers and financial planner are available to assist our clients as they need. Thank you.
Thank you, David. Thank you, everybody. Those were some great comments. And just a reminder, you can post your questions in the Q&A spot. We do have one question in already about inherited IRAs, David. And the question is, can you wait until the 10th year to withdraw money, or do you have to start withdrawing it right away?
Sure, that's a great question. And that's one thing that's unique with this change there. If you have an inherited IRA for someone who died in 2020 and thereafter, there are no more required minimum distributions. So yes, you can defer all your withdrawals to that last year, but be careful if you have any sizable amounts of IRA assets, it all has to be withdrawn by the end of that 10th year. And that could create a substantial tax situation if you don't plan for it correctly. So yes, absolutely, you can defer all the way to the bitter end.
Great, thank you, David. Turning back to the economy, we talked a little bit about inflation, and I'm curious, are we, the Fed has pumped in a lot of liquidity in the last year. It seems like actually it's been 10 years since 2020. But how worried are you about inflation, and what other things might we be doing in portfolios to counteract inflation?
Question for me, Jennifer, on that one? Sure. It touches on some of the things that I presented in my comments, that we are already underweight bonds and are considering adding commodities. One gets you sort of away from inflation, and one maybe runs you toward it as a way to sort of benefit a portfolio should inflation, particularly inflation that comes from consumption, scarcity and economic recovery, rising prices. So that's an additional item in client portfolios. Elsewhere, and not to be forgotten, the equity market, as long as the inflation is gradual and controlled and choreographed and well managed, a soft landing, if you will, or a soft sort of extrication from some of the stimulus, the equity market could be quite happy with that, because if it's coming because the economy is roaring again, equities as really could certain equities, of course, particularly those that might be aligned with commodity and consumption industries, would do well. So, and we already have positions throughout those sectors. As I mentioned, though, we could be rotating toward them still a bit more as the COVID recovery takes further momentum.
Thanks, Dave. And we've got
add a couple.
Oh, go ahead. Sure.
If you don't mind, sure. Yeah, so certainly within the fixed income portfolios, you want to look out and make sure that you don't have excessive duration in the portfolio as interest rates are moving higher. So we're looking closely to make sure portfolios, the durations are within the limits and the parameters established, with our clients, as well as the direction of our fixed income team, and also looking, at assets that don't have extension risks. So for example, mortgage-backed securities have a tendency to lengthen their duration or maturity as interest rates climb. So we're reviewing portfolios that have exposure to mortgage-backed securities and are favoring the types of fixed income assets that reprice more frequently and can capture those higher yields as they move higher. And then in addition to that, as Dave indicated, there are some sectors and industries within the stock market that tend to behave a little bit better during inflationary timeframes. Banks happen to be, one of them. So, financial exposure, as Dave indicated, to corporations that can benefit from higher pricing of commodities and assets of those nature. So there's room within all the major asset classes to make adjustments in order to prevent damage, and in some cases actually pick up return.
Thank you. There's actually another question regarding inflation, which is, do we see inflation as a short-term flip or more of a long-term increase?
That's a matter of hot debate, and there's a couple of points of color I might put on that. There is inflation to the extent that it comes into the numbers, but to the extent that the market starts anticipating it and worrying about it, the financial effect could still come through. Whether the CPI gets to a certain level, maybe to a degree a moot point. It's really, does investor sentiment and market expectation get to a certain point? And the other thing that is a bit of a newer or a louder factor in this is that the Federal Reserve is rooting for inflation, and sort of perhaps a be careful what you wish for sort of moment, but it's consistent with a lot of the political motives is to allow inflation as sort of a necessary evil of all of the things that we need to do to get our economy recovered, and all of the things that go with that, the stimulus, the debt issuance, et cetera. So in the short term, it probably would be a little bit more profound, but that doesn't mean it would go away and be gone in the long term. The Federal Reserve has said they would like it to be above 2% sort of durably for an extended period of time. So not just a short-term blip above it, but a sustained and kind of ingrained inflation. We don't want those inflation expectations to go to zero and go through the floor and have those animal spirits kind of be entrenched in deflationary camps like Japan has had such a problem with. So the lesser of the two evils is to root for inflation and let it run. And that should be further reinforced that Janet Yellen, who started some of this movement when chair of the Federal Reserve, is now Secretary of Treasury. So we have friendly components there with Powell, one of her sort of proteges, in place now at the Fed, but she is now on the Treasury. So a couple of folks are really rooting hard for it with a lot of influence over markets. So a bit more in the short run, in fact, encouraged in the short run, but also some degree of staying power, I think, for the longer run.
Great, thank you. Changing subjects, somebody asked how the merger with Wellesley Bank and Wellesley Investment Partners went. And so I will take that one. It went extremely well. We closed the merger on June 1st. And then during the month of September, we converted all of the Wellesley Investment Partners clients over to Cambridge Trust agreements, and then did close the structure of the registered investment advisor, but all of those clients became Cambridge Trust clients. Things are going extremely well. We have merged processes and procedures together. Our investment strategies were already very complementary. And so I think bringing the teams together has gone extremely well. Those of you who might live close to Wellesley will have noticed that the signs have changed to Cambridge Trust signs. I'm a resident of Wellesley, as is Stieg, and so we have been happy to see our hometown bank become a part of the broader organization. But I would say things are going very, very well and really continuing without any changes going forward. Let's see. Okay. David Strawn, question on Is there something that the client should be doing specifically in their portfolios in advance of potential tax law changes?
Well, it's difficult to say. First of all, if somebody is already in that 10-year window, then you know your time horizon. So it depends on your level of risk you're willing to take. Somebody who says, okay, in 10 years, I know I'm going to have to take this all as cash. I don't want to create a lot of risk. So it may be appropriate to lower the risk profile, but to add more fixed income or cash into a portfolio that they know is going to have a fixed maturity date. But for other folks who are still benefiting from their retirement account, we don't know when that 10-year time frame will begin. So your same goals and objectives and asset allocation strategies should apply. So some people would say, geez, I have a 10-year window, I'm just going to let it fly. That's their choice as well. So it's really appropriate to have a conversation with your portfolio manager about your goals and objectives, your how much risk you want to put into the portfolio and then implement that strategy.
Thank you, David. There are a few questions around technology stocks and the fact that Facebook and Google and Amazon have been flying high, and what do we see as the future for those? And they've been such a big part of the returns. How are we thinking about portfolio positioning?
Sure, I can offer a few comments, and Brian or Steve, welcome to join in as well. They do have vulnerabilities, undeniably so, particularly with regard, and this is sort of again with the perhaps of the good news could become bad news, in that these have become so ubiquitous and so dominant that they can't hide in the shadows anymore. They're right there front and center, and that puts a regulatory and antitrust target on them, both here as well as, of course, around the world, Europe among them, where they are vulnerable. Our analysts factor all of this in. There is political risk and regulatory risk to all of these names. However, often our debates circle around to what are the outcomes of some of these cases should they come to pass, or regulations should they come to pass. These are very financially robust companies. So fines, though they may be appropriate, they can be absorbed. These are not at a critical financial juncture for any degree of financial penalty that might be imposed. And in other situations, should they be broken up, for example, in the sum of the parts, some of those parts may be worth more independently than in the conglomerate. So that remains to be seen. It may foster more competition as would be intended, but these still have as such great brand equity that they may be just fine in those kind of environments. So don't mean to dismiss those issues at all. They are very real and are part of the consideration, which is also bodes well for some of the considerations around trimming and rebalancing that we're talking about. We think many of these have some kind of perpetual staying power and ownership potential in client portfolios, but the question is at what size? And so maybe taking a little bit of the profit and rally off the table and diversifying to a bit into other corners of the market. The other aspect is they have become such dominant members of index and index percentages that even if some of these names are favorites of our analyst team, it's hard to sort of own them in the size that the index might imply for risk management perspective. So there is a degree of kind of ubiquity for these names. They'll be part of the portfolio for the long haul, but we are not naive and being too cavalier about those risks. They're very much under consideration. So I don't know, Brian, if you have anything further you would like to add on that.
Yeah, the only thing that I would add there is, I think it's important to put into perspective the level to which they've outperformed over the past 3 to 5 years. And that just was exacerbated when the pandemic hit. Coincidentally, they just happened to be in the right space when people went remote, whether it was, software or hardware providers and children that needed access to laptops and tablets and things of that nature. Digital payment, now that so much more commerce went online, as well as, the unwillingness of consumers to, if they did go in person, to touch cash. So, these are all large components of that group. And it's not that the performance of tech companies has been poor. If you take a look at the earnings reports, they've generated tremendous amounts of free cash flow. Their earnings results have been good. Revisions have continued to be fairly positive. It's just that compared to some of the COVID damaged, areas of the market, in the past few months, we've seen some rebound from extremely low levels in some other areas. So if you were to look at a straight, price chart of some of the large tech names, they haven't deteriorated all that much. It's just that if you look at that relative to, say, the energy sector or, some other areas that really struggled in the first 3 quarters of 2020, there's really been some outperformance in some of those beaten down areas. So it's areas that we're looking at and considering. But again, difficult to sell names that are in such a good position still, but have to certainly take into consideration some of the risks that Dave mentioned, some of the antitrust risks and things of that nature. But in general, we still like a lot of those names, but we're looking for other opportunities as well.
Yeah, so there are tactical reasons where these certainly could pull back. But one of the key metrics in technology valuation, really any valuation, is total addressable market, the TAM. And just the proliferation of technology, the bull argument is that total addressable market just keeps expanding. So even if there are these shorter term pressures, that the long-term momentum is still towards a wider audience and a wider customer base for these companies. So being long-term investors will probably tolerate a degree of volatility to be there for the long term.
Great, thank you for that. That's an extensive answer. Thank you very much. David Strawn, question about Roth IRAs, and should somebody take advantage of a market downturn if and when it were to happen to do a Roth conversion? And maybe you can also explain what a Roth IRA is at the same time.
Sure. Well, a Roth conversion is taking money from a traditional IRA and realizing the taxable income at that time, and then converting that into a Roth IRA. So it is now after tax money, and all the future earnings are tax-free. So if you make withdrawals in a future date, all the withdrawals, regardless of their source, the original funding or the earnings, would be tax-free. So it's a very beneficial situation. The challenge is that when you take that money out, it is a taxable event. It's fully taxable income. So to answer your question, it really depends. It depends on your own personal tax situation. Now, if you say, I have the ability to realize $20,000 of income, then you would do 20,000. It's probably better to do it when the market is up and your investments have appreciated so much. $20,000 is $20,000, but you'd rather do it at the high side than the low side. Now, if there's a dip in the market and you take money out then, there really is no real difference. It's just taxable income.
Wonderful, thank you. So I think we have time for one last question, and we had a couple of questions about our exposure to the international markets and what our thoughts are on those markets, and how would we implement increased exposure if we decided to do that?
Sure. So our exposure to international markets, with the exception of the global asset allocation GAA strategy, which does things solely in ETF format, for the individual security strategies, it would be more of the same, in that our international exposures are a mix of individually selected securities covered and sourced and monitored by our analyst team, as well as some appropriate mutual funds and ETFs to help round out the picture and broaden that international reach that we can have. One point I might make, though, and we are hard at work on slicing and dicing data around this, is the distinction between US equities, international equities is and will remain important on paper, but it is perhaps less of a line in the sand than it used to be, because many US domiciled, US index members are as global as anything you can find in Europe or Asia. That's not, or emerging markets. It's not to say there aren't reasons to do international. I just wanted to sort of tip the hat to some of our domestic corporations are as global in revenue and client base as anything. We find Asia sort of particularly more attractive relative to the rest of the world. We think emerging markets would benefit from a global recovery. And are to a degree, it depends on the country, but to a degree beneficiaries as vendors and exporters of commodities. So they could be another way to play that kind of a cycle. So did that sufficiently cover the question, Jennifer?
Yes. Actually, there was an add-on to that. What about international fixed income?
Yes. So emerging market debt is a part of most of our portfolios, and international investment grade or sovereign treasury bonds of other countries, less so. There are the yields there are low, and in fact often lower than the U.S. yields, negative in certain places, and even flatter yield curves in our own. So it's not a common holding. It is an available tool in our toolkit, but where we tend to go first is toward emerging market debt, and emerging market debt in the decades or so has improved in its credit quality. So there is a bit of a pejorative aspect to emerging market debt being junky or high risk. There are components of it that absolutely are, but there's many more countries in membership there that is investment grade, BBB or otherwise. So it's a bit more of a diversified cohort than it used to be. And so that tends to be a place where you can find some additional yield. It's often dollar denominated in the way that we invest in it, typically through mutual funds or ETFs for this corner of the market. There are aspects to how you might want to consider currency exposure. International investment grade and high grade government bonds tend to be as much a currency opinion as any comment on the sovereign in question itself. And we do think the dollar could be positioned for more weakness, but prognosticating currencies is a very tricky game. And so it's not often it's certainly not the sole reason why we would make a maneuver internationally. It can be a supportive tailwind, but for the most part, particularly given that as much as we want our clients to be diversified, clients' liabilities are dollar-based and mostly domestic-based. And so that tends to be where we put the assets as well, but certainly are in the market for international when it makes sense on a relative value basis.
Great, thank you very much. So we have now reached 5 o'clock. Thank you, everybody, for the wonderful questions. We didn't get to all of them, but we'd be happy to follow up with you if there are particular questions you would like to have us answer. I also want to give a shout out to our tech support, Michelle and Allison behind the scenes. Thank you for making this go so smoothly. And to our clients and friends, thank you for participating. Stay tuned. Our next event is coming up on March 29th, where we will be hearing from Kelly Horan, who is created a podcast called Last Seen regarding the theft of the paintings from the Gardner Museum. And it was a fantastic podcast. I think she'll be a really wonderful speaker. And so you will see that coming out sometime in the next couple of weeks. But thank you again. Thanks to the panelists. Great job. And we will look forward to seeing you all soon. Thank you.